Welcome to the ICCG video series where we try to bring some clarity and conversancy for business owners in buying and selling a business. I'm Grant McQuilkin, and I am without Dave Parker, my business partner today, because we're talking about tax strategies when selling your business. I get to play the lead in those kinds of conversations because of my couple of decades as a tax guy. Most of us business owners have tax advisors, and that's the typical response we get when we're talking to business owners about being taken care of in this area. We make decisions on a daily basis as business owners that create a successful business by being informed before we make those decisions. And taxes can amount to between 1/3 and 50% of the proceeds of this big transaction in your life. And so it behooves you as a business owner to at least know the basics so that you can make good decisions and successfully exit with the most net in your pocket. So let's get a little bit of the basics out of the way. The IRS code defines several types of income. The best kind, obviously, is non-taxable income, right? We all know that. But there's just not a whole lot of that. But when you're selling your business, to the extent that you have basis in the assets that you're selling, that part of the proceeds is not taxable. And so knowing what that is critically important. But the two you hear about most are capital gains and ordinary income taxes. The main reason is that for most taxpayers or most business owners, capital gains are treated less than taxed less than ordinary income. But the truth of the matter is there's more types of income than just capital gains and ordinary income. There's pass-through income, there's unearned income, there's earned income, there's portfolio income, self-employment. There's so many of them, and it's really complex. But only a few pages of the tax law is actually dealing with the rates. So today, let's not deal with the whole code, but let's just talk about, in general terms, the tax rates that apply to you when you sell your business. Again, there's lots of nuances, and you really need the services of your tax advisor to help you through this. But generally, when you sell a capital asset, think equipment, real estate, shares in a corporation, or goodwill, that you've owned for longer than a year, the net profit, which above what you paid for it, is called a capital gain. This is generally taxed a lot less than your ordinary income, the stuff you get from wages, selling inventory, the normal profit of the business. Currently, in 2022, the capital gains tax rate is capped at 20% on the federal side. And now there are some state taxes and maybe some Medicare taxes that are added to that. But the tax on ordinary income goes all the way up to 37%. And then on top of that, there's your Medicare and state taxes. So the difference is about 17%. And so it impacts your net number in a big way. So if you sell stock in your corporation, you pay capital gains tax on the difference between what you get and less transaction costs, less what you paid when you invested in the stock, when you bought that stock. This is no different than your transactions that you have in the stock market. However, if you sell assets of your business, whatever you allocate the purchase price to will predict the tax treatment. So if you allocate an amount to goodwill, then that amount generally will be taxed as a capital gain. When you allocate proceeds to accounts receivable or working capital in general, it's going to be treated as ordinary income to the extent that it hasn't already in your normal P&L. you need to be aware that the sale of shares in an LLC is not treated as a stock sale generally. It is treated as an asset sale. And so this is true not just for an LLC, but also a partnership. You can't sell parts of a partnership in a closely held situation. You also need to be aware that if you have a C Corp, there's no capital gains tax treatment inside of that corporation for selling your assets. So you're going to pay ordinary income tax on that, on the proceeds regardless. So as part of the negotiation process, after agreeing on price, a buyer and seller have to agree on the allocation of that purchase price. This is a critical part of the negotiation. Allocating proceeds to equipment that you've depreciated can actually produce ordinary income, even though it's a capital asset, to the extent that you have depreciated it. This is why the seller wants to allocate as little as possible to depreciated assets, but the buyer wants to allocate as much as possible because he can write it off. This is why negotiating the allocation is so impactful on the net that you're able to achieve. Your representative will want to allocate proceeds to assets like goodwill because that's capital gains tax. This is just one example of how the allocation can impact it. Having somebody at the negotiation table who understands these tax nuances and what and the consequences of whatever direction the deal is taking at the time is so helpful in making sure that your net goal is accomplished. Every deal has some hair on it, right? Things that need creative solutions to get around. Good intermediaries find ways to get around those, but I've seen so many times where those creative solutions actually scuttle the tax strategy and cause a massive amount of tax burden just to get around something that would have been easier to handle just by paying for it. In summary, we all know that we want capital gain income rather than ordinary income. But more than that, you want to walk away with the most possible amount and accomplish your goal for the net. So you don't care what type of income it is. You really do care about the net proceeds, and your advisor needs to help you do that. That's the priority. Again, at ICCG, we'd love to help you with your transaction. If you are needing advice, give us a call, email us, go to our website, go to our blog. If we can answer any questions, we'd be happy to help.